Okay. Thank you, Chantal. And thanks to all of you for being here. I know there's a lot going on right now. It's great to see many of you in the flesh. Hopefully you got a bit of a sense or a bit of a lens into how we think about our technology and our business model and our opportunity. I'm going to bring us home this morning. I'm going to talk a little bit about our financial profile, some of the ways in which technology shows up in our financial profile, some of the ways in which our financial profile is unique, and also talk a little bit about our risk profile as a business and how it's been evolving over time. But before I get into that, I'm just going to reiterate a couple of key messages you've already heard this morning that I think are important. The first one you heard from Dave, that this is not a small opportunity. You all already know how vast the space of credit is. Mispricing is ubiquitous in credit. As Dave said, every single borrower who paid back their loan is paying a tax to subsidize a bunch of strangers who did not pay back their loan. Okay? The majority of borrowers do pay back their loan, by the way. That means that the majority of the mispricing is overpricing. This is not a 50-50 thing. Very often that default subsidy, by the way, is the single biggest component of the APR, which means this is not insignificant overpricing. It's significant overpricing to a majority of the applicants. And we've all just kind of accepted this as normal because this is the way it's always been, but we shouldn't, because it's a consequence of poor risk models. Now, from a process standpoint, any of you that have accessed credit recently, as Dave said, I think probably viscerally knows how excruciating the experience can be. Why? Well, we're all paying a process tax because of a small minority of applicants who are going to attempt to defraud the lender. Because we don't know who that small minority is, we all pay a pretty heavy process tax for it. Okay? By the way, pricing and ease of process, as Dave said, are the two single most important buying criteria in this consumer space. And other than maybe pioneering digital distribution, I think that our industry, frankly, has not done too much to innovate on these two core value principles, these two value propositions. And I think that anyone who can and will is going to make a lot of money. Okay? Now, hopefully you've gotten a sense for the fact that as a company, we are technologists at heart. Paul talked obviously a lot about how we think about these problems. To us, the clear answer to these problem statements in this vast space have to do with better models. Okay? Better modeling directly addresses the two core value propositions of this product. A better model will allow you to reduce more of the default subsidy everyone is paying by doing a better job of avoiding the defaulters. And because a majority of the borrowers are overpriced in this market, a majority of them will benefit from this. Better models allow you to dispense more money with less friction. Why? Because it turns out these models do a pretty good job of guessing who the minority of the people are who will attempt to defraud you. And so it allows us to hyper-concentrate the friction on that minority of applicants, and it allows the rest of us to run fast and free. There's a lot of hand-wringing in AI circles these days about monetization models, right? Who is going to make money from these interesting new technologies, and how are they going to make money? We think we already have a pretty good answer, right? We have an already existing, very large industry with a lot of inefficiency, and better predictions directly improve the two single most important value propositions of the product. AI, for us, is not a talking point. I hope you understand that now. It's not a flavor of the month. It's not an R&D project on the side that is attempting to generate insights that will then get brought to some credit committee so it can then get coded into a rules-based system. Okay? This is at the root of our DNA. We've been laser focused on this mission since the earliest days as a private company, we've spent the time and the effort and the money and the R&D to build what we have, and it's foundational to our production systems. It's not an exaggeration to say that our credit committee is an AI model. We don't believe you can do this thing half-baked. That's philosophical to us, and this is how we intend to approach these problem statements in this industry. You heard from Chantal about our vision for how we want to take this technology and create a very unique business with it. A business that is the destination to go for all things credit, that's relevant to all borrowers across the entire spectrum. A brand that's broadly recognized, a set of consumer relationships that start highly engaged and follow you throughout your lifetime. An ability to underwrite that's always going. This is a vision for a business that I do not believe exists today in fintech, and that's the opportunity we're pursuing. Now, from a unique business, you would expect a unique financial profile. And there is a lot of ways in which I do believe our financial profile has unique aspects, and a lot of those arise from our specific use of technology. Okay? We have a unique growth model in lending. It's a direct result of how our technology evolves. Technology gives us a relatively uncommon degree of control over our pricing and our take rates. Technology allows us to control and reduce variable costs, and in what is otherwise a very competitive market, carve out healthy and expanding margins. Like any good software business, you expect good leverage and productivity from fixed resources out of technology. And if you put all of that together, look, ultimately what we all care about, what you and I care about, is that as we execute, this is a business that throws off profits. Okay? And I want to touch on each one of these and talk a little bit about how technology impacts these things. Okay, we have a unique growth model in lending. As Paul said, you would be right to be skeptical of rapid growth in lending. Right? Why? Because at some steady state, with static underwriting, historically, the only ways to meaningfully grow rapidly in credit are either by ramping your marketing costs and risking your unit economics, or by opening your credit box and risking your credit performance. Those are not particularly sustainable ways to grow a business. However, if your underwriting is dynamic, you do not have to make that terrible choice. Why? Because dynamic underwriting, as your model gets better and better and more accurate, you do a better and better job of reducing the default subsidy. And as you do a better job of reducing the default subsidy, your APRs improve. And the immediate thing that happens when your APRs improve is that your conversion rates grow. Okay? And there's been a lot of periods in our recent history where we've demonstrated very rapid growth, and they tend to be very correlated to periods in which we are achieving conversion gains. Now, it's not the destiny of conversion rates to go up and to the right ad infinitum. Okay? At some point of very high conversion, rationally, you should spend more money to increase the top of your funnel because of how productive that funnel has become. And so over time, model gains start to take the form of more marketing spend and more volume at flat to declining acquisition costs. That's a pretty magical model as well. Regardless, this is a unique model in lending because historically, there's not a long history of people who have dynamic underwriting which improves at consistent rates. So, importantly, what I want you to remember when we next go through a period of very rapid growth, and we fully intend to, this is not necessarily a sign that something is wrong. It is possible to grow quickly in lending if you have dynamic underwriting. Remember this. Okay, a second unique aspect of our financial profile that arises from technology is that we have a relatively high degree of control over our take rates. If your underwriting is commoditized, you will generally end up playing in a highly competed segment of the market, along with a number of other competitors who probably have somewhat similar underwriting. You will generally end up as a price taker. Generally, you will originate loans at something close to break even, and you will earn the money to run your business off of the market yield of your assets. However, if your underwriting is differentiated, you're not resigned to this fate. If your underwriting is differentiated, you can perceive hidden value in the borrower base that the market does not appreciate. And if you can perceive unique value in the borrower base, you will enjoy a degree of price inelasticity in the demand for your product. And the better and more accurate your models get, the higher the degree of price inelasticity you will enjoy. You guys saw the chart that Paul put up. It showed how we sort of price a random sample of borrowers relative to the market, and they had dots where we priced people and ranges where the market pricing was coming in. And hopefully what you noticed is in a lot of that chart, and certainly the borrowers that we like a lot, there's a lot of room on that chart. It means that we can raise our take rates meaningfully for those borrowers and still be the best rates in the market. That's where the inelasticity comes from. Okay? That's what has allowed us to raise take rates very meaningfully, in our case in recent history, anything from 40 to 60%, and raise them accretively to the business. Now, like conversion rates, it is not the destiny of take rates to forever go up and to the right. At some level of high take rate, right, you have the luxury of exploring the trade-off between less current economics and more future volume and lifetime value. And so rationally, at some point, you will moderate your take rate, and you will invest some of that in the ability to cross-sell a higher future volume, an increasing number of increasingly long consumer relationships, and monetize them via a growing product portfolio. The vision of cross-sell that Chantal talked about a little bit. Okay, but all of that is sort of beside the point. This is all internal calculus and optimization. The key point here is, in our core business, because of our technology, we are generally not price takers. And it is generally true that our take rates do not come under pressure from outside competition. In addition to rising take rates, technology gives us the ability to control variable costs and expand margins. One of the two large cost components, variable cost components of originating a loan, is the operations costs you incur when onboarding a new loan. Right? And as Paul talked about, if you have very good verification technology and good fraud modeling, you can take a lot of that cost out of the system. And as you have seen how our automations grow, our automation rates grow, we've taken a lot of that cost out of the system. At the same time, the second large variable cost you incur in the origination of a loan is the acquisition cost. And as Dave said, in general, acquisition costs tend to grow as your business scales because the next marginal consumer is harder to find. But because of the growth model I described, we've demonstrated an ability to scale our business at flat to declining acquisition costs. Now, when you combine increasing take rates, decreasing operations costs, and flat to declining acquisition costs, you get margin expansion. And you've seen our margins, our contribution margins, expand from the mid-40s to as high as the mid-60s over time in what is otherwise a very competed space. Now, again, I'll make the disclaimer. It is not the goal of our company to increase contribution margins up and to the right. It is the goal of our company to maximize the number of contribution dollars we are earning. And so we will decide to launch and incubate new products that will be dilutive to the contribution margin, but accretive to the contribution dollars that are falling to the P&L. And we will make the appropriate trade-offs between current economics and more lifetime volume and value as makes sense. But again, the key point here is that in what is otherwise a heavily competed space, technology has given us the room to create very healthy contribution margins and a unit economic profile that technology can improve over time. We think that's relatively unique. Okay, the next thing you'd expect if you invest heavily in technology is a certain level of leverage or productivity from your fixed resources. Of the salaried headcount at our company, more than half of them sit in the technology organization. That's a rule of thumb that we keep track of, and that's important to us. Why? Because it means we're investing a certain appropriate amount, reinvesting a certain appropriate amount into innovation and R&D. Okay? What's the outcome of that? Well, one of them is, for example, if we were to execute on the guidance that we've laid out for you for this year, we will once again reapproach a ratio of roughly $1 million of annualized revenue per salaried headcount. That's a heuristic that we think is a good rule of thumb for a software business. It means you're getting good productivity out of your resources. Okay? It means that as we have grown the top line of our business over the past couple of quarters, a significant fraction of our cost base is steady, and it's creating the room for EBITDA margins to grow. Okay? And that's what you've seen with our business over the past couple of quarters. In a sense, operating leverage allows the top line dollars to fall very efficiently to the bottom line. And speaking of the bottom line, ultimately what we care about, of course, is GAAP profitability. We were a bit of a strange bird as a private company, in that we were GAAP profitable for a large chunk of it. Of course, back then it was kind of held against us, frankly. Back in those days, as a private company, the fact that we were GAAP profitable, the venture capitalist community just basically thought that meant that we were not very serious about growth. It was weird to be GAAP profitable. Now, of course, as you know, we're very serious about growth. But we think that in lending, there's a good way to grow and a bad way to grow. And we decided that growing with GAAP profits would be a signal that we were growing the right way. And of course, that carried on into public life. In early public life, we were sort of GAAP profitable for the first 6 quarters post-IPO. And you know, in the rough sort of cohort of fintech IPOs from that era, that was relatively rare as well. Now, obviously, our sort of goal of remaining GAAP profitable has been challenging as we've navigated the elevated default risk environment of the last couple of years, unquestionably. But we've maintained a priority in returning to GAAP profitability. That's been very important to us. We've guided that we will be getting back there in the second half of this year, which I think is safe to say is ahead of most people's expected schedules that I've talked to. And as you can see, we're well on track to accomplishing that. Okay, so you put together a model which has a unique growth profile, strong, high degree of control over take rates, an ability to carve out healthy margins and reduce variable costs, operating leverage, ultimately profitability. And I think it's worth reiterating, our intention is to do all of this in a model of low capital intensity. Okay? We're not trying to do this off the back of net interest income. There's nothing wrong with net interest income. It's a perfectly good revenue stream. It's not the one we're going for. We continue to have no intention of becoming a bank. I think we may be one of the last platforms standing in that regard. There's nothing wrong with the bank. It's a perfectly good business model, not for us. Why? Because the ambitions we have around scale and velocity are such that we don't want them to be limited by the need to furnish all of the capital ourselves, frankly. We've spent a lot of time and talked a lot about the fact that we've put in place a network of partners who are bringing third-party capital to the platform. Frankly, we think that's working very well. We do have a balance sheet, and that's an important tool for our business. It's important to say. Okay? It allows us to launch and incubate new products at velocity. It allows us, frankly, to co-invest in some of those partnerships and achieve a level of co-commitment and resilience that is important to our capital base. So this is not a no capital model, and it's not a no risk model, but it is a low intensity capital model that will scale well and allow us to be very nimble as we push the further frontiers of risk. Okay? Now, all of the things I just talked about, growth, profitability, capital light are all great. It is worth saying all of these things, well, on the one hand, I think we've demonstrated versions of this at points in our past across the board. So these are not leaps of faith. They're things that have been demonstrated. On the other hand, they are all things that have come under strain in the past couple of years as we've navigated this high-risk environment that we're in currently. Okay? So I think it's natural to ask, how are all of these things going to perform the next time there's a macro downturn? Are they all just going to kind of fall away? And I think that's a very reasonable question. It's a question we've spent a lot of time on. We've spent a lot of time thinking about it and debating about it and working on it. And I think there's a bunch of things about our business that have evolved and that will continue to evolve such that the risk profile of our business is going to look very different as we sort of prepare to navigate future macro disturbances in the force. Okay? Some of those things have to do with diversification along various dimensions of our business. Some of those things have to do with resiliency on the funding side of the business. Some of those things have to do with some of the macro tooling that Paul has talked about. And I'm going to quickly touch on some of these. Okay, on the borrower side of our business, the first axis of diversification that is important to us is on the borrower side of the business. Historically, you may have thought of us as a business and a model that competed disproportionately well in certain segments of the risk spectrum, and as a result, having had certain concentrations of borrower pockets in certain areas of the risk spectrum. I believe that is an old mental model. Dave and Chantal explain why increasingly we believe we are relevant to borrowers across the entire borrower base. That is sort of playing out in the mix of borrowers that we have and how that's evolving. It's leading to a greater breadth of distribution across the borrower base, more balance across the various segments, a greater diversity of borrower types. It means that when we encounter the next macro sort of bump in the road, we'll have more stability and more diversification in the borrower book. We will be less exposed to segment level and sector level shocks. And we'll have less pockets of concentration in the borrower base, particularly those near this 36% rate cap, which is really the only hard constraint we've placed on our business. Okay? So overall, a more resilient and stable borrower base as we grow. The second vector of diversity is along the product axis. Historically, originally, we have chosen to train our risk models on unsecured installment loans. Because this product is at the bottom of the payment waterfall, in some sense it is the purest expression of borrower risk, and therefore the best way to learn. And it has served our model training very well. The downside, of course, is that you're at the bottom of the payment waterfall. Right? But now you're starting to see the momentum we have in new emerging products. That momentum is early, but it's real. Okay? These are products, on the one hand, that have more security. They're higher up on the payment waterfall. And in a macro disturbance, because they tend to be secured by cars and homes, they're more stable. On the other hand, you have another set of products that are shorter duration in nature, shorter term. And a smaller duration means you have less exposure to future macro events. So you take these together, and as it grows, you're going to see a product portfolio that has increasing amounts of security. It's at different points in the payment waterfall, and maybe a sort of increasingly short duration will limit some of the macro volatility along the product dimension. The third point is something we've talked about at length, and I won't belabor it, but it has to do with the resiliency of our supply chain on the capital side. Okay? Today, more than 65% of our capital base is in committed form. That's up from 0 not very long ago. These commitments are with capital partners who have durable capital. They themselves are typically in the business of raising and deploying money across larger time horizons and across cycles. The agreements are designed to disperse across the cycle. We are co-invested with them, and we have skin in the game. And I'm very confident that this will be a more robust capital model than the one we had of a few years ago. And frankly, we may be getting a mini test of it as we speak, right? Ever since Liberation Day, and notwithstanding the recent, agreement with the Chinese, you may have noticed that the markets are skittish. And treasuries are up and spreads are up. And I think if we had been in our old capital model, I don't doubt that we would be fielding calls today requesting pullbacks in May and in June just because we're a little nervous. And as it stands with our existing partners, we are in the boat together, we're navigating the environment, we are aligned and sharing in the risk, and everything's working exactly as designed. So far, so good. The fourth point is the point that Paul raised, so I also won't belabor it. But suffice to say, our original obsession as a company was with borrower selection. And in the last few years, as you've heard, we've pivoted a non-trivial amount of our resources to becoming good at measuring the state of the macro precisely and reacting to it quickly. And we now think we have what is some pretty unique tooling in the industry. And if we had had that tooling a couple of years ago, as Paul said, of the underperformance that our loans have experienced in this period of turbulence and high default, we would have avoided well north of half of it. Okay? So that's a real source of value we are now delivering to lenders and investors. I think it's a very unique set of tooling, and it means that the next time we enter some macro turbulence, we're going to be able to navigate it much more artfully, much more precisely. There's one more thing that I didn't really put in this framework, but I am convicted in it, and I wanted to sort of at least throw it out for consideration. And it has to do with our revenue model itself. Today, our revenue model is highly transaction fee-centric, obviously. That is, in many ways, a good thing. In fact, it was certainly useful to us as a young, underfunded private company because it means that you get all your revenue and, more importantly, all of your cash up front. It's a very efficient way to build a business. Now, of course, the downside is that it's very sensitive to in-period transaction volumes, and we've seen the effects of that. There is one revenue line item that we have that was much more resilient over the past couple of years. It is our servicing fee revenue, right? And the reason is because that's a revenue stream that's paid ratably over the life of the loan, and therefore it's much more related to your outstanding book of loans that you've originated over the prior years and much less about your in-period transaction volume. Okay? And I think you're going to start to see more revenue models like this. The obvious sort of near-term example is in auto. Okay? As that business scales, I believe we will see more and more of the economics materialize in the form of servicing fee revenue that will be paid ratably over the life of the loan. It'll be a more resilient, slower to grow, but more resilient stream of revenue. Some of the other things we haven't talked about as publicly, but maybe you can intuit from Chantal's vision, right? If you think about a set of consumer relationships that are increasingly durable, that are increasingly cross-sold across many products, where underwriting is sort of more and more persistent over the duration of that relationship, it may not surprise you to know that we're starting to experiment with things like revolving forms of credit and subscription models. Obviously, much more reoccurrent in nature as revenue streams. Those are things that I suspect we will have more to talk to you about in the coming quarters. And one thing that's maybe farther out there, because frankly there's no active energy going towards this at all in terms of business model, but I'm actually very convicted in this, so I want to put it on the table. I sort of at the highest level view us to be in the business of applying AI to all of the different components of the loan origination process to improve them, all today in the service of loan originations on our platform, okay? But if we're very successful at that, I think there's every opportunity to carve out specific components of that process and to offer them as standalone businesses or services. And the one that really comes to mind that's obvious to me is in the servicing space. And Paul talked a little bit about the efforts we're making. We spent the last 2 or so years really focused on deploying our technology chops to making the service sort of processes that we have better and in some ways quite unique. And if you think that servicing is a business that could benefit from AI models. And if we're successful in being at the forefront of that transition, I think we have every opportunity to open that up to the broader industry and to make those services available, maybe servicing as a service to the broader space. And that's an example of something that I think is an exciting opportunity. It would obviously be much more correlated or very decorrelated to our own loan sort of platform portfolio volumes. And so I'm painting a picture of sort of increasing diversification across the borrower base, increasing portfolio of products that are sort of at different points and stages of the payment waterfall, an increasing resilience in our capital base, tooling we have that is unique that's going to allow us to navigate twists and turns in the macro. And then I think over time, maybe a bunch of emerging revenue models themselves that are decorrelated from our transaction volume. All that will create a bit of a different risk profile for our business as we navigate future macro. It's not going to decouple us from the macro, obviously. We are, at the end of the day, in the business of applying technology to credit. And there's a macro component. But I think in terms of the sensitivity and the volatility in our business that we've observed in the past, it's going to look very different as we scale and mature as a business compared to when we were a one-product, borrower-concentrated youngling with relatively understanding of the macro around us and an at-will capital base that we were still learning to manage. So I'm going to leave you with that thought and conclude my remarks. I'm going to reiterate what Sonia said at the beginning of the day. We're very grateful to have your time. I know this is a group of people, I know most of you, you are amongst the busiest people I've ever met, and the sheer amount of information you guys have to get your head around in your day-to-day, not just with us, but all of the things that you cover is mind-boggling to me. And I know that taking an entire morning to go deep on a specific technology is a luxury that you guys don't often have. And so the fact that you guys are happy to spend your time with us this morning, it's very meaningful. So on behalf of the entire leadership team, thank you.